Here to discuss the outlook for mining companies, we have Olivia Markham, Portfolio Manager on the BlackRock World Mining Trust. Olivia, welcome to the studio.
Thank you for having me here.
Could you give us a bit of an outline on the trust and how it works? What's the mandate there?
Sure. So we think about the BlackRock World Mining Trust. It's an actively managed fund, really with the goal of providing a diversified exposure to the metals and mining sector. Now, this trust is mainly invested in publicly listed equities, but we do have the flexibility to invest in up to 20% in what we describe as unquoted holdings. So privately held investments, royalty investments, investing in mining debt securities. And we use all of the tools really that are available within the investment trust structure to try and maximize the total shareholder returns for shareholders.
How important is that ability to invest in the less liquid and private instrument side of it? Large contributor performance in 2022. Has that carried on into this year?
Yes, I think when you look at the plethora of opportunities in the sector, I think it's great within the trust structure that we can do things in the public market, but also in the private market. And last year, we had some real success in the private market. In the trust over the last 12 to 18 months, we've had 4 private investments, and we've also have our long-standing investment into a copper and gold royalty in Brazil. Last year, our private investments was a great source of returns for the holders of the trust. We had 2 companies go from private to public with very successful IPOs. We had another company who is still private today, but did a funding round at a significantly higher valuation. And then our royalty investment, while it didn't change the value of the royalty, it was actually acquired by a much larger and very well-known mining company today.
Staying with mining companies, devoid of debt, they've got good balance sheets. Is the outlook still looking good for a lot of these companies?
Yeah, absolutely. I think what I've been really encouraged by in the sector over a journey now of 5, 6, 7 years is been the discipline that the sector has had around its capital allocation frameworks and keeping that focus on shareholder returns, but then also investing in value accretive growth. So, we've been through periods of times over the last couple of years where this sector has generated incredible amounts of free cash flow, but the discipline of the sector hasn't waned. And I think this ongoing discipline, is really important in terms of how people assess the companies, the valuations that this sector could trade at, but also the outlook for dividends and returns for this sector as well.
Because the dividend outlook's been strong and they've given a lot of cash back to shareholders.
Yeah, absolutely. So if we think about the new capital allocation frameworks and how they have changed from, I guess, the last cycle to this cycle, the first point is they're very clear. If you look at the major mining companies, they're very clearly laid out capital allocation frameworks. Dividends are linked to earnings. There's also, frameworks within that to ensure that there is sufficient spending on sustaining capital, decarbonisation capital. But then ultimately, when we think about the outlook for the dividends, it's really going to come down to where commodity prices go to in the future. So we've had an incredibly strong period over the last couple of years of very high commodity prices in some of the bulk commodities, and that's supported some really strong dividends. Today, we've seen dividends come down a bit, but these are still dividends that are all covered by cash flow, and the companies trade on still very attractive dividend yields.
Staying with commodities, and I think we spoke before, prior to this, it was about brown to green for a lot of these companies. How many of them are really, really positioned now to do well out of this energy transition?
Yeah, so I think you can almost take that in 2 parts. So I think the mining sector, the materials sector has a really important role to play in supplying the key metals that we're going to need to enable the transition. The copper for the grid, the lithium and the battery materials for electric vehicles, the steel for the wind turbines, etc. So, they're going to benefit from the growth that's coming through from the transition. But at the same time, many of these companies are carbon intensive. So we also need to see them reduce their own emissions so that we can produce these materials in a cleaner, lower carbon way. So I actually think that this sector, the metals sector, is probably an underappreciated way to get exposure to the energy transition.
What's the supply looking like, especially in places like China for a lot of these mining companies? What's the story there?
So if we think about metals supply, we have been through, as an industry, now many years, we're getting close to a decade of underinvestment into new supply. Partly this has been because companies have been deploying less capital into this area, but actually it's just becoming a lot more challenging to permit new mines, to fund them, and actually to find them through exploration success. So generally, when we look at supply, it is quite constrained, and that's kept commodity markets quite tight. If you look at a region like China, whilst they are a very large consumer of many commodities, they're not necessarily a large supplier of a number of the key commodities that we need for the transition, like copper.
Mm. And how flexible can you be when you're shifting allocations in different commodities? And what's the portfolio breakdown looking like at the moment?
So we're dynamic in terms of our commodity allocation. And our commodity allocation is quite, within the sector is broad. We have exposure to the precious metals, gold and silver, to the base metals, to the bulk commodity. And increasingly, we've been building up our exposure into these newer areas linked to the transition. So the battery materials would be a classic example of that. So we are dynamic, and a good reference point to this is how we've moved our precious metals exposure around. We had a large proportion, almost 40% of the trust exposed to precious metals, at the beginning of COVID. And we brought that down, by sort of 10 to 15%, as we could see the reflation trade and the recovery trade come through post-COVID. The other thing that I would highlight here is, within the trust, we're invested in equities. So we do have our views on preferred commodities, but we're also trying to balance that in how we can best express that view into an attractive company, an attractive equity. So we do need to think about both of those parts.
And a lot of these are income payers, dividend payers. What's the yield looking like on the trust at the moment?
Yeah, so when we think about the yield on the trust, a large proportion of that is made up by some of the larger companies in the portfolio, which consists of our top 10, and they're a large contributor to the trust. So if we have a look at the trust today, the yield is around about 6%. That's been fairly constant throughout the course of 2023. I think the other thing which is important for people to understand with the income and consequently the yield of the trust is how we generate that income. So, around about half, a bit more than half of the income from the trust comes from the underlying holdings in the portfolio. But then what we look to do is to supplement that income by using the tools within the trust. So we have our royalty investment. We can invest in mining debt securities, and we use the gearing facility within the trust to be able to do that. We're able to do some option writing to generate income as well. So, the investment trust structure allows us to generate additional income that is not available from just investing in mining equities themselves. And
you touched on it there. Gearing is a very important part of the trust structure. What's the level at the moment, and have you seen some good opportunities to really take advantage of? So
once again, we try and be quite dynamic with that gearing facility. At the moment, gearing is around about 12% of the portfolio. Now, there's a certain proportion of the portfolio as well that is unquoted, so is static. So we want to ensure that we're kind of gearing against that if we think that's the right thing to do. And we've, over the course of the year, we've taken that gearing facility up as high as sort of 16%, and we've brought it also under 10. So we do try and move it around quite a lot. The other thing I just point out on gearing, which I think is important to understand, is that we are using the gearing facility in a cyclical sector, and I think that's a real advantage to have. But we're also using a gearing facility in a sector which is arguably undergeared. We have very healthy balance sheet, low debt levels from the underlying companies. So I think actually our gearing, when you sort of look through that to the portfolio, is actually quite conservative in some respects when you look at the underlying holdings in the portfolio.
Interesting. We do have a question from one of our fund selectors, John Stratton from Albert E. Sharp. He said, the uranium price has spiked recently. What are your thoughts on the prospects for uranium? And do you see this becoming a larger part of the portfolio in the future?
So uranium is a really interesting commodity or fuel, and certainly getting a lot more attention as we think about the energy transition and, lower carbon sources of energy, of which uranium is one. What we have seen over the last 12 months is that, yes, the uranium price has moved up. That spot price has moved up. It's now over $70 per pound. But importantly, the longer term price has also moved up. And that's actually where the majority of volumes are traded in the uranium market, which is where the utilities contract. So we're generally seeing improving fundamentals around the market. We're seeing the life of nuclear reactors being extended. We're seeing buying in the stock market at almost 10-year highs now. And we're also seeing, I think, a changing approach to uranium from government. So I do think that is improving the overall fundamentals of this industry. Within the trust, we have built up exposure to uranium. You'll see from our most recent interim report and the disclosure there that we have built up an exposure in kind of the leading uranium producer out there in the market.
I just want to finish on this. What do you think investors should be really wary of or should be looking out for when they invest in these kind of markets and commodities in general?
So I think one of the things that we haven't actually talked about today, and I think it's very core when investing in the mining sector, is ESG and each of the components of E, S, and G. And we very much consider ESG factors, ESG risks, ESG opportunities as a core component of the fundamental work that we do on companies. And I think what we have seen over time is that companies who don't display strong levels of ESG typically will be exposed to more risk than other companies in the sector, and that has the potential for adverse share price outcomes. So we are certainly very focused on it when we manage the World Mining Trust, and I think when we look forward for this sector, the key focus at this point in time is very much on the E. And I think that the mining sector is in this unique position where it can address E from the carbon piece of E from two sides, by providing the metals that we need to enable the transition, but also reducing the emissions intensity of their own operations.
Olivia, great place to leave it. Thank you very much.
Thank you.